Hello again. This is Chuck Whitford, JRG Advisors. Again, welcoming you to our webinar. Please be advised that if you have questions, you can type them in on and we'll get them and answer them at the end. And then within a few days, you'll be getting a copy of this presentation along with the Q&A and the access to the recording, the replay. Again, we welcome all of our valued clients and partners to this event, this webinar this morning. Today we're going to discuss healthcare reform, including the employer mandate and the latest developments. Now we all know that healthcare reform is so simple it can be summarized on one slide. And I'll wait until everyone's done reading the slide. Actually, this has been around really since the beginning of the whole healthcare reform process, and sad to say, it's a lot more complicated than this chart is by now. And we're going to cover what's going on now and what we look forward to in 2016. Last month, the President signed into law a bill that had bipartisan support, which hardly ever happens these days, and made some employers think that the infamous employer mandate was repealed for mid-sized employers. Unfortunately, that's not the case. It was good news for employers with 50 or more employees that do provide health coverage. The reason is that it prevents the same sort of benefit mandates and rating restrictions that had afflicted the smaller employer. As we all know, the mandate itself survived the Supremes in June when they ruled that subsidies are in regardless of whether or not it's a state-run marketplace or federally run marketplace. Healthcare reform, the ACA Act, has broad implications on more things than just medical coverage, as it's understood and as the various regulatory agencies interpret the law. Two examples are how it impacts health reimbursement arrangements and flexible spending accounts. It used to be that HRAs, standalone HRAs, which we'll discuss in a second, were legal entities, and that's changed. The flexible spending accounts, there are limits to what an employer can contribute to an FSA. We have many employers who do provide some payments to help their employees with the medical costs. And because the ACA has what they refer to as market reforms, it's only exempt from ACA rules if it's called an accepted benefit. And under a flexible spending account, the interpretation is basically that the employer cannot fund more than $500 more than what the participant's deduction is. So if someone does not participate and provide any of their own money into an FSA, for instance, the most an employer can do is fund up to $500. This is an area that is not as well known, doesn't get the headlines, but it can get you in trouble and subject you to penalties if you're not aware of how this all interacts. For over 50 years, the IRS recognized the legitimacy of what were known as employer payment plans. Referred to now in the news as standalone HRAs, their practice allowed an employer to reimburse employees for their costs in buying insurance on their own. As I said, this is a long accepted practice. There's private letter rulings dating back to 1961 from the IRS allowing this. The three agencies that are in charge of regulating healthcare reform, Health and Human Services, Internal Revenue Service, and the Department of Labor, rarely agree on anything, but on this they do agree. Due to market reforms, because of the ACA, this arrangement is now illegal. You cannot tie the purchasing of insurance as a requirement for getting a reimbursement, whether you do it on a tax-favored basis or an after-tax basis. Now, there's obviously nothing against raising someone's pay, but if you have a plan that has this contingency, it's not legal, it's not in play. And as you can see, there are penalties should you be caught. $100 per day after June 30th, 2015, if you're a small employer. If you're a large employer, there was no grace period, and those fees can go back to as far as they can evidence that you've had this program. So if you have an arrangement like this, you need to get rid of it. You need to change it. Despite the fact there are some marketing groups out there that keep saying that this is a legal thing, it's not, and you need to pay attention to it. Another area that was unintended or not really thought of when the ACA was passed was the impact on high deductible health plans. When the government created the requirements for a plan to be considered a qualified high deductible health plan, and by qualified I mean that you were allowed to open up a health savings account, it was standard that if you covered dependents, you had to satisfy the entire family deductible before the plan paid any benefits, with the exception, of course, of preventive care. The ACA, however, has set out-of-pocket limits on individuals, and the effective January 1st of 2016, the impact this has is it makes those issuers of high deductible health plans have to change their format to cap the an individual out-of-pocket maximum, and for a qualified health plan, that's $6,550. Today, as people are looking at bronze level plans to offer to be in compliance with the ACA, we're seeing deductibles as high as $5,000 per person or $6,000 per person, and that translates to a family of either $10,000 or $12,000. Again, that's in violation of ACA. So so every carrier has realigned their portfolio to make sure they're in compliance. And of course, this causes disruption as you have to communicate changes to your employees on these plans and how they work and how it's different than what they're used to. The two qualifications for what we call a qualifying offer under the employer mandate are affordability and minimum value. The affordability is the area that probably we've gotten more questions on than what minimum value is, as any carrier is going to issue a plan these days, a true group plan will be of at least a bronze level value, which is a 60% actuarial value. Affordability in the law is defined as not having to pay more than 9.56% of an employee's household income. Now, as an employer, of course, you don't know what the household income is. You don't want to know what the household income is, and at least under the law, they provided some safe harbors so that you don't have to find out this information. And I'll cover them just briefly here. If you use the safe harbor, you need to use the statutory 9.5%. The 9.56% is an indexed amount which the exchanges will use to determine eligibility. The three safe harbor methods, well, 9.5% of their W-2 Box 1 wages, that's allowed. Or if you have, particularly in the area where you have variable hour employees where their hours might be 20, might be 30, might be 40, up and down, the law allows you to work out their pay at 130 hours per month, and as long as you charge 9.5% or less, that's considered affordable, regardless of what their actual income is. And of course, the third level, which we don't really see any employer going for, is this federal poverty level, of course, because that would create the largest employer cost, because it would produce the smallest employee contribution for a plan. And the cash out option that we still see employers providing to their employees will be part of this calculation. As I mentioned, minimum value is a bronze level plan. Typically, a $5,000 to $6,000 deductible is common. The carrier will need to attest that it is of minimum value. As I said, there won't be any carrier issuing a plan that doesn't hit that 60% value level. And of course, there are penalties if you don't, if you're under the mandate and you don't provide coverage. And we'll cover them briefly here. First penalty is what we refer to as a sledgehammer penalty. Now, again, in 2015, they revised the regulations that you need to offer it to 70%. Well, we're past 2015 at this point, so let's talk about 2016. The law is that next year you need to offer it a minimum essential coverage to 95% of your full-time 30-hour employees. If you don't, then that penalty, which is triggered by one person getting a subsidy in the exchange, the penalty is equal to $2,000 times all your full-time 30-hour people, less 30 in 2016. There was 80 this year. But for next year's planning, it's 30. So if you have 30 or fewer full-time 30-hour employees, then the requirement of the employer mandate doesn't mean as much to you as it would if you had more employees. And that's one of the important things to calculate for those that may have to change their program to comply with the mandate. And that's the most important thing, is to evaluate what's the cost of a non-deductible excise penalty, excise tax, versus the deductible cost of offering coverage. Penalty B is the tack hammer penalty. And this is simply that if one of your full-time 30-hour employees receives a subsidy, because maybe you're offering them a minimum essential coverage, but you're not offering a plan that meets minimum value and or affordability standards, they'll be eligible for a subsidy, in which case they're penalized $3,000. The way this works, and it's kind of complicated, a MET plan is valuable in that it provides protection against the individual mandate, and it protects you against penalty A. If an employee purchases a minimum essential coverage, they in essence are not eligible for a subsidy. So if you offer a MEC and an employee does not take it and goes and gets a subsidy, you will get a bill for $3,000. As I said earlier, the Supremes ruled in June in favor of the subsidies in all marketplaces, and that meant that the employer mandate is here to stay at this point. For most of the applicable large employers, that means 2016. And as you know, the mid-sized employers, those with 50 to 99 full-time equivalents, did not have to comply with the mandate if they met certain conditions, which we'll list on the next slide. As you can see, the government doesn't want you to reduce your workforce unless you had a bona fide business reason, although they don't define what a bona fide business reason is. And most importantly, you can't reduce or eliminate coverage. And the very last item is probably the most important, that is often ignored, and that is that your contribution as an employer for employee-only coverage has to be at least 95% of the dollar amount in effect on February 9th, 2014. And you might ask why these specific dates, and that's because these are the dates that certain guidance came out, certain changes in the interpretation. And so I think this is extremely important for those in the 50 to 99, because when you fill out your reporting in January, which we'll talk about in the next webinar, you'll need to indicate and attest that that you didn't violate any of these rules of transition release. So going back to the employer mandate, as I mentioned, you offer the MEC plan So at least 95% of your full-time 30-hour people and dependents, and that eliminates penalty A, which we talked about, the sledgehammer penalty, and satisfies the individual mandate. For each employee who accepts the MEC, there's no subsidy, which means no penalty B, $3,000 per employee. Those that go to the marketplace and get a subsidy, you'll get that bill. So most employers are avoiding the penalty by offering a minimum value plan, and that's affordable if they can. These insurance markets are very challenging, so depending upon your own situation, it may be easier or more difficult to obtain the cost of a competitive bronze level program. And it varies widely from marketplace, from areas, even within Pennsylvania, there are different regions that it's easier to get a bronze level plan that's affordable than others. And some other issues. The PCORA fee, that's really the establishment of protocol in the future for how to treat conditions. Some people would have referred to those at the very beginning of this law as the death panel, but it's important to know that the fee is increasing to $217, and it's most important. Many employers have fully insured plans, medical plans, and so the insurance company will be taking care of the PCORA fee and, of course, passing along to you. However, if you have a health reimbursement arrangement, that's considered a self-funded employer plan, and you need to know that about filing Form 720 every July for the applicable amount. Now, you don't have to count everybody that's covered under the HRA, meaning all the dependents. The rules say that you just need to count the number of employees covered under the health reimbursement arrangement. The second thing, the employer exchange notices. This is different than what you need to be giving out to all your new hires when you notify them of the availability of the marketplaces. And you need to do that, by the way, whether you have offered coverage or not, whether they're eligible for coverage or not. Now, this employer exchange notice, this will be the first year that the marketplaces will be charged with validating that employees actually do qualify for a subsidy because they were not offered a plan that met minimum value and affordability. And with the we assume that after the current open enrollment season ends, that in the spring of 2016, we're going to be seeing these sent out to employers. And you have 90 days to respond to the notice, to appeal it, which shows, again, you need to have proof that you have offered a plan of minimum value and affordability to your employees, your full-time 30-hour employees. And this is the way they're going to validate the whole system. Then what this means is it's just going to create another series of paperwork back and forth. And this is before the Internal Revenue Service gets involved after they've reviewed your 1095-C and 1094-C filings, which, again, will keep that excitement until next week. Also, the FSA contributions, they used to not have a limit. Then they put a limit on it, and that's strictly to raise tax revenue, because for every dollar that you don't pay in taxes is a dollar they lose in revenue. The limit is going to remain at $2,550, which was 2015's limit as well. It's unchanged. Another issue that has not been on the radar for most is this transparency reporting. The Affordable Care Act required that insurance companies provide a performance score, performance information publicly, and that was delayed from 2014. But the expectations are we're going to get regulations around this next year, and there will be some interesting data, particularly on the number of claims denied and their practices. So that's coming up down the road. I want to spend a couple minutes just on compliance. If you have a health or welfare plan and you don't have your taxing authority or conduct most of your business on Sunday, you're required to have a written summary plan document. Government entities and religious church groups are exempt from ERISA, but everybody else pretty much is, subject to the Employee Retirement Income Security Act of 1974. I've talked about ERISA before, and the trivia about it is that it was the first bill signed into law by President Ford 3 days before he pardoned Richard Nixon. It was on Labor Day 1974, and it was considered a victory for employees, focusing mainly on practices with retirement plans. However, it does extend to health and welfare plans, and the Department of Labor is the entity that's responsible for enforcing compliance. And why this is being mentioned and why this is important is the DOL is committed to audit every group plan for compliance with the Affordable Care Act. And while they're there, of course, they're going to look at ERISA, since they've been in charge with enforcing it for well over 40 years now. The SPD really is the first thing the Department of Labor asks for. They don't come knocking at your door. They usually send a letter with a lot of requested documents. So it's important to have one. There have been huge penalties paid for employers that either didn't have one, thought they had one but didn't have all the requirements, or they didn't deliver it properly. There are a lot of rules around that with electronic delivery versus in paper, versus posting it in the lunchroom is not considered delivering it, and the penalties can add up. There was a recent penalty of $74,000. This has happened within the last couple of months, involving an employer that sort of ignored their responsibility for a couple of years, and it can certainly add up. And there are other cases that have averaged in the 10,000 to 20,000 range. And we mention this because we at JRG do have a solution for you that we'll be happy to talk to you about. By the way, it's good to note that a benefits booklet generally is not an SPD. One other thing that we need to consider in terms of plan documents is your cafeteria plan, otherwise called a Section 125 plan. Sometimes it's as simple as a premium-only plan, referred to as a POP plan. And this is what allows you to deduct employees' contributions on a pre-tax basis. Now, occasionally we run across people who do this as a business practice but don't have a written document, which is certainly a no-no. You want to make sure you're covered with an appropriate document. One thing that the Affordable Care Act has caused is, particularly when you're dealing with a lot of variable hour employees, people get into a plan because they work 130 hours a month during the standard measurement period, and then they find their hours are reduced, either voluntarily or for business reasons, and all of a sudden that deduction looms larger and larger as their pay gets smaller. Well, the rules haven't changed for the employer. You're still on the hook to provide coverage for that entire plan year if they qualified during the standard measurement period. But the employee can elect to get out of their coverage if they have a reduction in hours, and they tell you that they enroll or intend to enroll in other coverage that meets MEC standards, minimum essential coverage. You don't have to prove that they're doing it. They just have to tell you that that's their intention. And then you're allowed to let those whose hours have slipped below 30 move out of the plan. However, the catch is this is new, and your plan document has to be updated to allow this as an additional qualifying event. And so if your document's more than a year old, you really, and this is an important provision for you, you want to make sure that document's amended to allow this new change. With that, we'll be happy to take any questions you might have about today's webinar. And of course, we thank you for listening in. I'm told I've done such a great job that nobody has any questions. Well, that's at least my interpretation of it, which I'll keep. But stay on for another minute or so. But of course, we at JRG appreciate your time, and I hope these webinars are considered valuable. We certainly would appreciate any feedback, any suggestions, maybe besides changing the narrator. But nothing. All right. Well, again, I want to thank you on behalf of JRG, and our next web event is Tuesday, November 17th, with the exciting topic of employer reporting requirements. So see you all then.